Good morning, everyone, and welcome to our event, the Raising Capital Seminar Series. I'm Mike Caldwell with the Greater Des Moines Partnership, and we want to welcome you today. We're going to get started in just a couple minutes, and contrary to normal Zoom policy or silliness, we want everybody to turn their cameras on. We want to see everybody. And you know, the usual is mute your mics. Well, if you can mute your mic while you're not talking, that's great, but this is an interactive session, and we want you to interact. So we'll give everybody a couple more minutes to get into the meeting. We've got quite a few people joining us today, which is a great thing to have a lot of people joining us. So give me just a couple minutes to let some more people get in our session, and we'll get started. Good morning, Aaron. Good morning, Bernie. I know a couple of these people personally. Jason, good morning.
Morning, Mike.
Jason, can't you teach this class yet?
You know, Mike, as many deals as I've been a part of, I've always wanted to take this class. So I've actually been looking forward to it.
Fair enough.
Yeah.
Well, I'm glad you could join us.
Hey, Mike, just so you know, the last probably hour, I'm going to have to be just dialed in on the phone as I drive to my afternoon appointment.
Yeah, no problem. I'll repeat this a few times for everybody, but just so you know, we will record all of this. Heavily encourage everybody to turn on the chat window, and I'll remind you that several times during the day. I'm going to make available the PDF of this deck during the session so you can download it. We're recording all the video, and we'll make that available on the partnership website. So if you miss something, don't worry about it. So, all right, well, Shreese, I think we're going to get going here. I think we've got a pretty good crowd. It looks like we've got 20 in the room already. I'm sure people will come in and out as the day moves on. So as I get my screen settled in here, we'll get going. So again, welcome, good morning. I'm Mike Caldwell with the Greater Des Moines Partnership. This is Module 1 of the Raising Capital Seminar Series, the steps to raising capital. And today's event will really be run by Shreese Flynn primarily. And I've had the pleasure of knowing Shreese, I think since 2010 or 9, since maybe the last great crash. 8, yeah, probably 8. Shreese has a really great background. She has worked with a lot of CEOs, execs, and teams of startups to work on growing their companies. She's been part of scaling a company, Dwala, was heavily involved in the day-to-day, honestly, the hardest part of raising capital, that day-to-day, going through the process. And it's been part of raising over $30 million in that situation. She's worked in San Francisco. She's raised money on the West Coast. She's raised money on the East Coast. And she's raised money here in Iowa. And by the way, those are 3 really different places to raise money. She's got a lot of background. You can see her bio there. I'm not going to read it all to you. I'm not into reading bios. Impressive person, and I've really enjoyed knowing her all these years. And she's not that old yet. This is a joint collaboration of 3 groups. This is the Greater Des Moines Partnership, LWBJ, and Brown Winnick Law. And we'll have presenters across our modules from all the organizations. So first of all, this slide is wrong. So here's what I want you to do. If you don't mind muting your mic, that's great, but please turn on your video. We want to see you. We need this to be as interactive as possible. Zoom burnout's a thing. So turn on your video, ask us questions, jump in. If you don't want to just interrupt, again, open the chat window. I'll be watching the chat while Shreese is presenting, and I'll be happy to pause, ask her to pause, and then ask you to jump in and ask your question, or if you just want to type your question, whatever you want to do, that's fine with us. So again, recording will be available. So here's the agenda, and this is for the whole seminar series. This is a 5-part series. Shreese and I have been teaching this series along with others for several years now. I think this is probably our 8th, 9th, or 10th round. I don't even know anymore. I've lost track. And every time we find ourselves pushing too hard to get everything jammed into a 7-hour session. So we've actually expanded it. So this morning we'll be covering Module 1, the steps to raising capital. It really is a good overview of the whole process. This afternoon is probably the most interesting for most people is the pitch, how to do a good pitch deck, because the pitch does matter. And so that'll be this afternoon. And then module 3, the pro forma financials. So building that financial model. I teach that class, that's coming up on the 14th. And all of you that signed up should have gotten an invite to all 5 sessions. And again, they're all recorded. If you can't make one, don't sweat it. Module 4, cap tables. I can't tell you how many entrepreneurs I've dealt with that don't understand their cap table, don't know where the cap table is. I see Jason smiling because he sits on the investor side of this mix, and oh boy, is that a problem when you don't know what's going on there. Understanding cap tables is the key to maintaining a decent stake in your company as you raise capital and making sure that you're going to have something come out of it when you have that great exit. And then the term sheet, the negotiation tool, the process of saying yes and coming to an agreement with someone on how much capital that you're going to raise and at what terms, and the terms are key. So with that, I'm going to stop sharing my screen and flip it over to Charisse. And if you want to go ahead and share yours.
All right, can everyone see that okay? Does alignment look good?
Looks good to me.
Okay. Good morning, everyone. I look forward to spending the morning with you and hopefully the afternoon as well. As Mike said, we have typically done this in one full day, and what we found is it doesn't kind of do it justice. We're always moving really, really fast through it. And we have found through running this 8 or 9 times that the most beneficial sessions are those that become very interactive with lots of questions. So we do have a lot of content to get through, but feel free to stop us at any time and ask questions. Again, Mike has the chat window up, so he will be looking at that and helping me moderate the chat. Excuse me one second, I might just take, I don't have COVID that I know of. I just have a little tickle in my throat this morning, so give me one second. All right, the fundraising journey. This part of the presentation really all came about when Mike said, hey, Charisse, can you lay out what's the linear process look like to raise capital? And I said, well, I can try, but I'm not sure that it's necessarily linear in my experience raising capital. You always have the intention of, okay, I'm going to do this, 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 and this, and at the end of it, I'm going to have the money. And what I found is it really fits more into several themes than necessarily a linear process. And if I boil those 3 themes down, I think of momentum, materials, and meetings. Momentum really being the starting point. The companies that I've seen raise capital the quickest generally have the most momentum going into their round. Momentum can mean a lot of different things depending on what stage of company you are. In the early days, it might be the momentum you have around the product and technology that you've built. You're able to build technology, release technology, and really show that you can do that at a fast pace. You might start to get momentum around your brand, more people hearing about you, PR, and certainly getting investor interest. Momentum around investor interest can also really help the speed in which you're able to close around investor commitments and closing. So all of those areas, the faster and the more momentum you have going into those areas, the more likely your raise is going to be successful. The other component, material, so pitch deck, financial model, due diligence, term sheet, closing docs, those are all things that you're going to have to have an eye on throughout the process. And then meetings, getting ready, meetings. Not only from pre-meeting, so you're networking with people, to practicing your pitch, to then actually starting to have formal pitches, ongoing meetings. You know, there's kind of this illusion, oh, my pitch with this group went well. When do you think I can have the money? And usually it's like 3 or 4 or 5 meetings later, you might get to some sort of real commitment. So don't have that illusion of, I had one great pitch, you know, show me the money. It usually doesn't work like that. Ongoing follow-up, the closing can certainly take lots of meetings, and then your board meetings will continue from that. So again, as I think about fundraising, momentum, materials, meetings. as I was stating, unfortunately, the fundraising journey, I would like it to be prepare, execute, manage the close. It doesn't usually end up like that. There's lots of ups and downs. You have these really high highs. Sometimes you go backwards, forwards. It does fit kind of these processes though. Prepare, all the preparation that goes into it. Then you start to execute on the relationships, on the pitches, on the documents. And then hopefully you get into this final kind of third stage, which you're managing the negotiations, the closing process, the relationships. One thing to know is this might be a little cavalier of the ups and downs, forwards, backwards. Ultimately, although the process can be chaotic, I do still recommend that you try to run it as a process. And when I say that, it's like getting ready for a horse race, right? You line all the horses up, the horses being the investors, and ready, set, go. If you're able to create more of a competitive environment where the investors are kind of all running towards the finish line with you at the same time, you're likely going to have more speed through the close. You're going to get better terms, etc. So I'm not saying don't run it like a process, but just be prepared that it might not, go quite as linear as what you may desire for it to go.
Therese, if I can add there, I think that one of the things I see as an investor is once one investor gets interested, then everybody piles on. And you go from nobody wants to talk to you to everybody wants to talk to you. Everybody wants your diligence information. Everybody wants you to answer their questions. And it can just feel like a fire hose. So when you look at that prepare, process, all that, do the prepare because there's nothing more frustrating as an investor to say, hey, go ahead and send me your deal doc or send me your diligence information. Let me in your deal room. And they go, oh, I haven't put that together yet. It's like, oh man, you're not ready.
Mm-hmm.
And so just, it's a real downer. So the momentum piece is about preparation.
Absolutely. That's a great point, Mike. Yeah, I've sometimes clients come to me and they're like, man, I'm having all these great meetings. And then I dive in with them and I'm like, well, how is your pitch deck? How are your financials? They're like, we don't have any of that. And I'm like, what are you doing having any, real investor conversations without that? Because people will entertain you for a while having coffee meetings or Zoom meetings, but eventually they want to dive in, and you want to be prepared for that. So it's not a perfect process, but if you were to kind of put down in a spreadsheet, these are all the different things that I should have an eye on throughout the process. I think this is a helpful lens. Again, starting with really focusing on momentum and keeping that momentum going. I think this ongoing piece is really important. I too often see where teams, they start to have investor conversations, and as they engage in the investor conversations, their company starts to slow down. And that makes sense in this because you're so engaged in talking to so many investors that maybe your product deadlines start to slip, or maybe those sales calls start to slip. I can't stress enough how important it is to try to manage both of those throughout the process. Because if you switch all your momentum to getting investor conversations, but this company is slowing down, they're going to start to say, show me your last 30-day progress. And if you don't continue to show progress, it's going to raise, potential red flags for those investors. So really coming in with a game plan of how am I going to keep the momentum going in my company while I also manage the investment process. Building investor relationships. We're going to talk about this, I think, a little bit later in depth, but developing an investor tracking sheet, what starts out as casually something you can manage via email, often, spirals into, oh man, there was like 50 people and what was that guy's name? And when did I last talk to him? And what did I last tell them? So the more you can be organized and track that going into the process, the better. Making contacts can really start to take some time. So thinking about how you're going to manage all that and the ongoing communications. Also, thinking about your investor strategy. We will be kind of doing a deep dive into this, but are you doing a family and friends round? Are you going after VCs, strategic angels? What's the plan? And putting some thought into that ahead of time can help save some time throughout the process of who do you want to talk to and where are you going to spend time. developing your pitch deck and practicing, that's an iterative process. I've seen people end up, by the end of their successful fundraising, on deck like 75. You might update your deck every time you have a conversation. Building your financial
If I can,
model.
Sharice, I'm going
Yeah.
to stop you there for a second. By the way, that's going to happen to you. You're going to keep changing your deck over and over. And you want to keep track of what deck you gave to which person. Sharice, I think, has a story about this, but the challenge is you gave somebody deck 21 and deck 38 is totally different. And they say, hey, I just looked at the deal room and the deck's totally different. What happened? So, or, send me your latest deck. It doesn't look like anything before. So you've got to keep track of what did you give them, right? And that's part of that investor tracking.
Yeah, I would create a Dropbox file for every investor I was talking to. And so as I was emailing them information, I would also start to put it in a file. So if they said, hey, I'm looking at slide 72, your sale, not 72, 17, your sales funnel, can you, clarify XYZ for me? I knew exactly what they were looking at. Building your financial model, that certainly takes some time. Again, we would recommend that you have your model ready to go before you start talking to investors. If everything goes quickly, they're going to want to see that within a week or two of really kind of validating that they're interested. Organizing your due diligence. Obviously, this is going to be iterative throughout the process, but if you can have the base formed ahead of time, it also will mean you're ready to go when people start to ask for it. Conducting investor meetings, ongoing part of the process, negotiating, managing the close, and then ongoing investor communications. So this probably is not all inclusive, but as I was reflecting on what were all the different things I had to manage throughout raising capital, I would say these were the high points. The unfortunate reality, fundraising takes time, not only in the day-to-day, the amount that you invest in it, but also over a period of time. We're seeing that most fundraisers take 3 months minimum. And when I say 3 months, that's from start of conversation to money closed in the bank. Lately, I would say, over the last few years, we're seeing more 6 to 9 months likely. And I know that that's a big bummer for a lot of you. Thinking about raising capital for 9 months is not where really anyone wants to spend their time. It just, unfortunately, I think is a reality, especially if you're in the Midwest raising capital. I find the coastal regions, capital, people move quicker. We're in this new era where I think that access to capital all over is opening up even more as we're doing Zoom calls, and investors are getting used to this new environment. But the reality is it just takes a long time to raise capital, create those relationships, and go from first meeting to money in the bank. The more momentum, the more relationships you have going into it, I think that can shorten the process. I saw a good friend recently, he raised within like 45 days, but he was coming out of a real known accelerator. And he was probably Mike, I don't know if you can add to this, he's probably the fastest person I've seen raise capital in the last 4 or 5 years.
And part of the reason, I wanted to bring this up, part of the reason he was so quick was many of the investors that he was getting ready to talk to, he already had a relationship with. And I think people too often say, well, I don't want to talk to investors until I've already have my pitch deck done, I've got everything done. Actually, you do. You want to have those cups of coffee 6 months in advance. If you know you're going to be raising capital in March, now is the time to say, hey, can I talk to you? Tell me what you're looking for. Tell me what makes a good pitch for you. Tell me what kinds of investments you look at, what type of, how big are you, what's your check size, and start that conversation early so you can vet out which ones aren't going to be worth a lot of time, perhaps, and which ones are your targets, and plan accordingly. But don't wait until you're ready to raise money to start that conversation. Investors really want to get to know you. They want to talk and learn who you are. I know with Next Level Ventures here in town, it's typical for them to start working with a company a year before they would ever write a check. And it's just part of their process. So don't hesitate to get to know the investors and talk to them and just be honest. Hey, I'm not ready yet. That's okay. That's beneficial.
And I think that that's a good point, an area to make clarification on, of being clear when you're raising money and when you're not. I think some people are like, well, I will be raising money. And it's important to state that in your conversation with investors of, I'm not ready yet to go through the process. I'm not ready yet to give you a formal pitch. I'm not ready to dive through financial models, etc. You really need to kind of control the story of when are you raising and when are you looking to build relationships. Because once you say you're starting to raise, that time clock really starts ticking. And in some sense, it can look bad if you say, oh, if investors have been talking, which is a small community, and they say, yeah, that person's been raising for the last 6 months, looks like they're not getting any, traction. You want to really tighten that timeline as much as you can. One thing I'm going to go through just some nuances here. If you raise from venture capitalists, there's a pretty typical process that's followed. To start with, there's a pitch, and then they most of the time have a team that does a basic analysis on your company. They might go through your revenue plans, try to understand where you're going the next 3 years. You might also want to start to meet some of their portfolio companies. They're thinking about competition, etc. This is like a high-level review. Before they would say, hey, we're very serious. We want to go into more of a due diligence track with you. Due diligence, before you go into deep due diligence with an investor, you want to make sure that their interest is really high and they're not just digging around and not just, going into it because they're interested in learning more, but they've really indicated, yes, these are some terms that we want to enter in with you. We're very serious about this. Once they do more due diligence, typically they would do an investment memo to their partnership meeting. And it's important to realize who the stakeholders are and who has control in saying yes. You might be working with a point person at a venture capital firm or within a strategic company, but really trying to understand, how do they come to their decision of a yes, no? Many VCs have this mechanism called the partner meeting. Well, someone will present your company at the partner meeting, and then as a partnership VC firm, they will vote on if they want to move to term sheet or not. This is where sometimes I see people hung up. They have a great relationship with one person, but that one person's not able to convince their other 4 or 5 partners. So the more access you can have to who's the decision makers and do I know more than one of them, your chances are going to go up. And it also helps you not get into this loop of partner meeting, partners wanting more info, partner meeting, partners wanting more info. Sometimes you can kind of get this circular that they're trying to continue to get to a yes, but it can put you in this like loop. It's better to get to a yes or no. So once the partners decide, then you can expect a term sheet, negotiate the terms, go through a more like deep dive financial diligence, legal diligence, etc. I would say don't, it's not normal to go into deep financial diligence or legal diligence until you have a term sheet. So if someone's wanting to go really, really deep, you can say, hey, hold up, like what are the terms in which we would move forward before you invest a lot of time and frankly, give them access to a lot of information you normally wouldn't just share with just anyone. So there's different, I would say, stages and expectations depending on where you are as a company. And there's articles and articles and articles online of, am I pre-seed? Am I seed? At the end of the day, I'm not sure it frankly matters how you title yourself. But we tried to find kind of the parameters of, if you say you're pre-seed, what does that sort of expectation look like? Money raised is usually, 0 to 250,000 that you've already raised or that you're going to be raising. There's really not usually a valuation at that pre-seed amount. Investors typically tend to be friends and family. Ownership, at this point, they really should be taking probably less than 5% of your company. It's really, really early at this point. Likely they're not going to have a board seat. Your team, what are they looking for in your team? That you're smart, committed, have relevant experience, but they're not expecting, hey, I have a CEO, CTO, CIO. They're just not expecting that at that stage. Where are they expecting your product, to be? Often at this stage, you might have market research and some, maybe early customer conversations that show that there's a need for the product, but the product likely does not quite exist. That's why you need the money. We're seeing even some pre-seed is wanting, as entrepreneurs, that you've already put your own money in to get to some sort of proof of concept or some initial technology at that point. I would say this is more relevant on the coast. Mike, you can add in here, tech. The coastal VCs really want you to have a strong tech co-founder. At this stage, I would say this is a little bit different in the Midwest. We're seeing tech being outsourced, in these earlier stages, because you just don't have that tech co-founder typically. But later on, especially in the Midwest, they're wanting to see your tech being developed in-house, not being outsourced. And then I'm not going to go through each one of these. I'm assuming most of you on this call are more in this pre-seed seed stage. But as you go through the fundraising stages, the amount that you're raising starts to increase. We're seeing seed rounds around here from 250K to 1-2 million. I've even seen some seed rounds. You don't even get to the Series A until you're like 3 to 10 million. Any questions when you think about the stages and what's expected? Hey, I'm going to raise money. I have no revenue. Is that going to be okay? And I would say yes and no, depending on what stage you are at.
Yeah, if I can add, Sharice, I think go back to the tech piece. When tech was much more difficult, pre-cloud, when you had to build a lot of stuff just to even prove you could do something, that tech co-founder was incredibly important. I think the reason you still see the emphasis on the coast is many of the things the coast is investing in, they're investing in very large amounts of money to go really, really fast. So part of that going fast is having your own tech people. Honestly, for a lot of the Midwest people, the difference is we're not quite as hyper obsessed on how fast can we go, and we're looking more for product market fit. So if you use a no-code tool to build your code, or your rough physical prototypes are just rough, as long as you can use those to prove traction. People look at your rough prototype and goes, absolutely, I would buy that. And I think it is worth the price you're asking. We're looking more for that than do you already have a manufacturing line set up? We already know how to get a manufacturing line set up. That's not that hard. So we're looking for product market fit. Software, hardware, it really doesn't matter. Domain expertise is what's important. If you're, in the ag space, you probably should know something about ag. Or if you're in the chemical dispersion through aerosol space, we probably should have a background in that. So I think it is relevant on how fast you're trying to go. And it's also relevant on what matters the most to the investors. And I do see product market fit becoming much more important.
One other point that I might make as well is I think there's good investors and bad investors out there. And I've had people come to me and say, hey, this investor's really interested, but they want 40% of my company. And I just shake my head. I think that most of the time you can get deals done for a lot less of that. And not giving up so much of your company early on is really important. So pre-seeds, and as you think about going along the way, each time you raise money, I always say the good rule of thumb is don't give up more than 20% ownership of your company in each round. So what makes a company fundable? There's a really great article in here that we're sharing, but we'll try to summarize, what's an investor looking at? Big market opportunity is a big one. They're often looking for $1 billion opportunity. And the reason investors are looking for a 10x return. And so it has to be a big enough market opportunity. Recently, I looked at a couple companies, and they're showing a market opportunity of like 5 or 10 million. And I'm like, whoa, 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 whoa. Okay, and you want VC funding? And some of it is just the way that you're being conservative of, well, I think I could make 5 to 10 million. Well, that's one thing, but what is the market saying? You know, if you were really able to scale and get a decent amount of penetration in the market, is there a big enough opportunity, or is it so niche that, you know, it's not really the type of company a VC would fund? Even I say VC, but I even think like angel investors. They're wanting to understand, hey, this is going to be more than a lifestyle business. If they're putting in their money in, they have to have a path to like how are they going to, you know, make a decent return. Um, Vision, you know, is the vision compelling? Is it exciting? Is there a good team in place? I know a lot of investors that will base, you know, their investment off of, do they like the founder? Do they like the team? Do they want to work with them? Can they see themselves being in relationship with them? And what is the commitment of the team? This can be a sticky one early on. Often entrepreneurs are working a full-time job and building another company, you know, building their startup on the side. But at what point are you going to make a full-time commitment? Because as an investor, if I, you know, give you $100,000, $200,000, I want you to be putting that to work and not this just being a side project. So having kind of clarity as an entrepreneur of when are you going to go all in on this endeavor that you're asking an investor to put money into. Strong business model. Is there, you know, compelling economics on how you're going to make money? Does it make sense? Is it straightforward? And then, you know, do you have some secret sauce? You know, what stops a Google, Amazon, Apple, other large company from picking up what you're doing, putting a ton of money in, and building it themselves? What's your competitive moat? What's your secret sauce? So those are, you know, kind of 5 great areas to think about. Yep, Mike.
So I'll give you a rule of thumb that I was taught, and several of us were taught in an angel investor class. It says that every investment can be put in one of 3 categories. It's oxygen. It's so important you need it to breathe and live. It's aspirin. It really is a pain solver. Or it's jewelry. It's nice to have. So when you think about your customer and what you're offering them, think about that saying of oxygen, aspirin, or jewelry.
I love that analogy. Mike, did they say, is there one type that's typically more fundable?
You know, it's funny because you see, like I saw a deal pitched the other day that was about champagne samplers. And I was just shaking my head thinking to myself, are you kidding me? This woman had the most amazing traction, right? She had found a niche of people and she was growing, like doubling every month the amount of champagne she was shipping. And it was big numbers. And I would have said, that's just jewelry. And it probably is just jewelry, right? Although maybe it's a form of aspirin for certain people, I don't know. But I think that what matters is what your investor thinks is great. I personally think that oxygen and aspirin are more important, right? I'm always thinking about what happens in an economic downturn. You know, we're in a downturn right now. Jason works for a large company, and a lot of it, you others on this call probably do too, or have in your past. You cut during those times. You look for things to cut. And so will it survive a downturn? Is it mission centric? You know, I've often heard the quote that if what you're pitching isn't solving one of the top 3 or 4 problems for the CEO of the company or the buyer from the company, you're probably not going to make it. So that's what I would add.
Yeah, I think also too, the trends of what's the economy doing? What are people buying? There's the saying of, does it make me money or save me money? And in different economic cycles, people care about those differently. All right, so what kind of round are you raising? I alluded to this a little bit earlier. Is it a seed? Is it an angel? Is it a bridge round? Is it a Series A? And I really love this quote by Mark Zuster. None of it will matter unless you build shit people care about and use in mass. And thus you can attract capital, even if you call it a Z round. My advice to entrepreneurs: stop sweating the silly optics. I love that quote, and I think that there's a lot of truth in it. The flip side is you want to make sure that you're calling around something that makes sense in the market. So you don't get a point where you're calling it a B round and everyone's saying, that's not a B round, that's a, you're still in C or seed. What are you doing? And I bring this up because I have a personal experience at Dwala. We in the Midwest, did $1 million round, and we call it a Series A. And $1 million in a Series A here seems like that was the round. When we started to raise capital from the East Coast and the West Coast, especially when we got to our C round, which was a $20 million round, they're looking at us and starting to evaluate us like we're in that C stage, and we weren't. We were at the B stage, but we were calling it a Series C. And it's all something you can overcome, but it took like a little bit of conversation, because initially they're just like, oh, Series C. They start looking at you and they're like, oh, you don't really fit a Series C. And we're like, well, our first round was $1 million. They're like, oh, well, that was a seed round. And we're like, well, yeah, it probably was, right? So it doesn't matter, but it does. And being just prepared to talk to the expectations that investors have. I would say some people want to rush to say, I'm doing a Series A. I think my advice is don't rush unless you're actually to the point where you start to hit those metrics, because you start to go down a path then of, at an A, you're expected to act like this. At a B, you're expected to kind of look like this. So although it might be a little silly, still be mindful of it. How much to raise? We're giving you what we call option A and option B. And option A, in my opinion, is really in the ideal world where you could be at a point of raising money for at least the next 18 months, being able to take into account what are all my development costs, maybe what are my inventory costs, what are my people costs, how long is it going to take me to sell something, and then how do I add some time in there, because we all know sales take longer than what we'd like. So you add in inventory, product development, people, burn rate. We added here, times 9. So the sales cycle times 1.5. And then you get to a number of 2.7, 2.7 million. And ideally, this gets you at least 18 months down the path. In a great market, this is the ideal way to raise money. It gives you time to figure out some of the product kinks. It maybe gives you time to figure out, hey, I run into some distribution issues. My sales cycle just takes a little longer than what I'd like to get, like it to be. And I still am able to achieve some significant momentum before I run out of money. So that's option A. Option B, I like to say this is the realist approach, and not maybe realist, but I think this is sometimes the reality we live in, which we can't always successfully raise that kind of ideal amount. And so I would say the kind of option B is raise enough money to achieve a very specific set of milestones that will attract the next round of investment. And again, although raising for 15 to 18 months is ideal, sometimes it really isn't a reality that we live in. Early on, you may raise a smaller amount that gets you a shorter runway. So you might raise for something that gets you 6 to 12 months down the road, but is able to really feel some traction in which your product has traction, your pilot customers have traction, maybe you get some more sales. And sometimes raising less allows you to focus on getting the round done and back to work. I've seen several entrepreneurs recently raise kind of what they're almost considering like a bridge round. It's like a seed round, and it's not, the big $1-2 million round, but it's enough money that they're going to be able to achieve some really exciting milestones, and they're going to have momentum to go do that bigger round. And hopefully, instead of spending 9 months fundraising, they're able to raise a smaller amount over a few 2, 3, 4 months, get back to work and show the momentum in their company. Mike, do you want to add anything on this one?
Yeah, I do. I think that, when you're looking at option A, option B, you want to know the option A answer. If somebody says, well, because I might ask that. I might say, what would it take to take you all the way to market? What do you really need? And having that full assessment and really having thought it through, in a lot of investors' minds, means you actually understand your business. Now, you may say at the end of that, I need 2.8 million. And I may say, I'm not ready to put that kind of money in. What could you accomplish in the next 6 to 9 months with a lot less? And the reason you want to think about that is if you raise 2.8 million early on, you're going to give up a lot of your company. Let's say you raise 500,000 and prove the market loves what you want, you're going to give up a lot less of your company. And so you raise 500K instead, you take it at a lot lower valuation, you give up a lot less to your company. You prove that you have something really substantial. I'm totally up for a bigger valuation. So you just grew the value of your company maybe 4 or 5x from a small investment. And I think that's really the key is what does it do to your valuation and your personal equity or your team's equity and your previous investors' equity when you raise too much too early. So I'm a fan of doing both, but trying to raise with option B, simply because if, assuming you don't have this just, Uber like, oh my God, the world's blowing up, just pour money on me and I'll make it happen. I mean, that's kind of a fantasy land anyway. So.
Well, I think sometimes option B and A go hand in hand. To talk a little bit about a company that recently came out of one of the accelerators, they kind of went down option B, did it as a safe convertible note, got the money in the bank, and now that's going to help them kind of fuel their growth while they go after this bigger round. And sort of they're like, we're going to close this, we're going to have the money in the bank, we're going to be able to hire some key people that help create this momentum so that as we go raise this bigger round, we're not waiting like all this time to get this like lump sum. We're able to put some money to work right now and fuel our company in doing it. The other thing I think that has changed, over the last 5-6 years are safe notes and convertible notes have a lot more favor than what they used to do. Some investors might still really hate convertible notes or safe notes, but they understand that they have a place early on in companies. And so you're able to do this sort of option B potentially as a safe note, convertible note, get the money in the bank, and then work on kind of this larger kind of option A round. What is my company worth? Unfortunately or fortunately, there's not always a lot of data around valuations early on. Valuations often are determined by how much an investor wants to own of the company. Typically, investors kind of at that little bit, 500,000 to 2 million plus raise. It's normal that they want between 20 and 25% ownership after the round is done. So your valuation it's like it's like math, typically 3 to 4 times the amount that you're looking to raise. So an example, if you're looking to raise $1 million, 25% of that of a 4 million post money valuation. Or if you're doing, you're looking to raise $1 million, 20% of that would mean you have a $5 million post valuation. Again, we would love that there's science or more data. A lot of people are like, is my company really worth 4 million? I don't even have a product. And I think investors would say, probably not. Is the idea really worth 4 or 5 million? Who knows? But they're kind of making they're making kind of a future bet that you put the money in and you will create value there. Later on, if you get to the B, C, D raises, I would say there is, whole companies that do valuations around where do you sit in the marketplace? What's your revenue? What's a 10x, look at revenue. There is more kind of like scientific data approach to it, but early on, when it comes to startup investing, this is sort of how they determine it. Again, it's at 20 to 25% ownership. Another thing, why we're seeing a lot of people doing safe and convertible notes is they don't typically want to value their company that early. And doing kind of a round like that allows you to not yet, place a specific value on the company.
I might add on that one though, when you do a note, a convertible note, or even a safe note, most investors want a valuation cap on it. I'm not going to get into too much of what that means at this point, other than to say you kind of are putting a valuation on it. There's a West Coast attitude of just do a safe note, don't worry about the valuation. That's kind of a, well, let's throw $50 at it and see what happens. I mean, their $50 is 50,000 or 100,000. It's $50 to me, but I'm not going to throw more than that at something just to see what happens. That's kind of where the safe note came from. And so you now see safes with side letters for pro rata rights and side letters for a valuation cap. And it's to protect the situation where, I put my 50K in on a safe note, and then, it gets diluted to the point where my 50K is not worth anything anymore. So just understand that you oftentimes will end up setting a valuation cap simply to protect the investor.
I think that's a great entry. For some of you, you're shaking heads like you understand that. Other people, that might be like a foreign language, what Mike just said. Know that when the cap table workshop will help you flesh out what does that all mean and see some live examples. So that's a little bit of the plug for spending some time later on doing the cap table module. All right, valuations. So I think this is really interesting. What we're seeing for seed and angel valuations really is dependent on what region you're raising capital in. So Silicon Valley, the valuations out there tend to be slightly silly, quite inflated compared to what we're seeing in the Midwest. But even other parts of the world, right? So if you were raising in UK or Europe, the valuations are much lower than what they would be if you were in Silicon Valley or New York. Iowa, typically we're seeing, a smaller raise, so around, 500, and a, sub $2 million valuation. It still fits this whole, they're taking 20% of your company, but it's like, how much are you able to raise and at what kind of valuation early on? So just know that. This plays into the strategy when you're determining how much to raise, what geography and what type of investors are you looking to raise from? Because if you're looking to raise 500K at a sub 2 million valuation, the Silicon Valley VCs are kind of looking at it like, you're not raising enough. I want to be putting more money to work than 500K. So if I'm going to look at your deal, I want to put $1 million in, and know what kind of pressure that's going to put on your company. I think this is really important of kind of understanding what kind of investor you're raising from and what their expectations are. Because if you don't kind of fit within their box, you're gonna have some friction. And people that might normally say yes may say no, because they think the numbers are just kind of out of their comfort zone. The same in the Midwest. We're liking a lot of rounds are smaller early on. Those pre-seed seed rounds typically aren't more than 500K. So if you come, blaring into the market saying I'm raising 1.5 million, I think a lot of people are going to say, whoa, why don't you raise less, hit a few milestones, and come back to me? So just knowing, again, what the market is used to is helpful.
I would also add here, as an example of the inverse of what Teresa said, ag tech valuations are higher in Iowa than almost anywhere else in the nation. Ag tech is hot here. And I actually have some friends that are investors in Chicago that say they get a lot better valuations back in Chicago on ag tech than they do here in Iowa. That when an Iowan sets the investment amount, when they agree to a term sheet with an Iowa group, it sometimes prices others out of the market. So it is dependent on what industry you're in and what investor group you're talking to. Shreese, do you want to take a short break here? I'm kind of thinking it might be a good time to take 10.
I think
we're at 9:20.
9:20, come back together at 9:30.
at 9:30, and I'll just leave everything on and just, yeah, we'll see you back at 9:30. Take a break, and we'll see you then.
Sounds great. Oh, look, okay. It looks like everyone's starting to come back together.
Yeah.
I'm just going to do a quick poll. I'm curious how many of you, maybe just a hands up, have already raised capital? Seeing one. Everyone else on the call, is this your first potential fundraise? Seeing a little bit of nodding. So, sometimes I also feel like we have a group here that's not actively looking to fundraise, but looking to learn and figure out if it's a path they want to go.
Therese, we got a couple questions here in the chat. I think I'll take the first one. Melissa, you're asking, is it safe to approach a VC or an angel with an NDA? No. I'll answer that really quick. Here's the thing about NDAs. I, for a living, mentor startups. And so I've probably worked with 1,500 startups in 13 years in various forms. I can't remember what somebody told me last week. And so honestly, to sign a legal document early in a conversation to say, I won't disclose what you do before I even know what you're going to disclose is almost impossible. And for venture capitalists, it's even higher and risk, because believe me, they've heard it all. And so what I tell people is, tell me, if you don't want to tell them how your magic works, tell them you got a black box. And here's what goes in, and here's what comes out, and here's why it's so damn valuable. And you don't have to tell them how the black box works. Not early stages. Now, maybe when you get into serious diligence, if you get into diligence, they will sign an NDA, right? At that point, they'll do the right thing and sign an NDA. But you're not going to get one for the first meeting at all. So that would be the answer to that one. Sharice, there's a question here from Mahesh on what is the best way to get a valuation. You want to talk through that a little bit? Maybe I can add some flavor to that as well.
Yeah, so a little bit back to what we're saying in a few slides ago. Unfortunately, valuations are early on really kind of a percentage of what the ownership might look like. If you're pre-seed, it's you could expect less than this 20 to 25%. You might, think that 5 to 10%. But if you really are like a 500K raise or above, that's where kind of this 10 to 20% will come into account. As Mike said, if you do a safe note or, do debt early on, you're not setting a valuation, but yet you're putting a cap. So in some sense, there is a valuation set. Beyond that, I mean, that's typically what we're seeing as far as how valuations are set. If you have revenue, sometimes that's a conversation, but we're some sort of multiple in revenue, but we're usually not seeing that wouldn't normally play out well in your favor early on, because you just probably won't have enough revenue. And if you do, you're probably further along in the funding cycle. And I know that that's tough. I don't know if that really answers your question and helps, but that's kind of the methodology that we see pretty normally. Mike, anything to add on your front?
Well, the only thing I would add on valuation is it depends on the kind of company. So like if you're talking about a SaaS company, the most recent data I saw was SaaS valuations are as high as 10x right now, legitimate 10x. People are getting that. Just 9 months ago, it was 7. And it's being affected by what the public market valuations are for SaaS companies. So there's a company called SaaS Capital, SaaS Capital. And they do revenue-based financing, but they're extremely good at research, and they publish a lot. And what they published recently, they go through this process. They say, look, whatever the valuation on the public markets is for a SaaS company, and right now it's like 12 to 15 in some cases X of revenue, 12 to 15 times revenue. They subtract a couple points from that for private smaller companies just because of the lower leverage. And use that as a basis. And they have very, very good data that they're basing this on. It's not just a wild guess. So Again, it just depends. If you're in a physical product company, totally different valuation. So you really have to get centric first to the type of product and the way VCs and angels value the type of company.
And maybe even one point to do some of the math on that. Early on, doing 10x in revenue is probably lower than looking at this 20-25% ownership range. So if you had 100,000 revenue, annual revenue times 10x, that'd be $1 million valuation. That's far lower than these 4 to 5 million valuations that we're talking about. If you base it just on, hey, I have a great idea, I have some initial product market fit, and I'm going to build a really big, valuable company. Therefore, you should somewhat overvalue my company early on. So that's where be careful of, like, where does revenue, a multiple of revenue, serve you, and where could it actually be lower than making more the case of, I have a really great big idea, you should be part of it. I'm going to create a lot of value for you in the future. You want in. Were there other questions in the chat, Mike? Are we?
Let's see. We got one more evaluation, then we're going to move on. Does valuation validated in other geographies relevant? Is it relevant, or does it have relevance to the U.S.? Context to the question is, we have an Iowa company, but are completely owned by an Indian parent. Indian parent has raised capital earlier. That gets complex. I can't answer that here, but anytime you have a parent company involved and the sub is raising capital, that gets very complex, and it has to do with international law. The simple version is, if there's a problem down the road, the cost for the investors to hire lawyers in another country and deal with another country's laws as it relates to a conflicted issue gets extremely high. So you're going to find that that's a scary situation. I'll take that one. If you want to just shoot me a note offline, I'm happy to connect with you, and I'll cut through. One more thing before we get started again. Please make sure you ask questions in the chat, or just unmute, if you will. Please turn your camera on. We love seeing you. Sharice and I are, we're on our own too. So the more we can see and interact with you, the better it is. And I've put a link out in the chat, and I'll do it again a little bit later for the presentation deck. So with that, Sharice, if you want to go ahead and get started.
All right, sounds great. So moving more into the fundraising process. You've done some of the prep work. You're ready to start fundraising. What does it look like? I would have to say, I'm going to admit, this took me many years to kind of have this aha moment. I'm not sure I was this thoughtful or aware when I was actually going through fundraising that it was a sales process. I was just like, it's fundraising. We're doing fundraising. We're doing fundraising. And the more that I step back from it, I'm like, it really is a sales process at the end of the day. And some people say, I hate sales, I'm not good at sales. Well, if you're the startup founder, you better learn to love sales, because at the end of the day, fundraising is sales. So everyone has probably seen a very normal, sales funnel. What does it look like? So I don't want to, insult anyone's intelligence. More, this is like a framework for us to kind of think and reflect of where you're at. What are some of the key things to do along the way? So starting at the very top, how are you going to fill the funnel? Building awareness. You think about what part of the sales funnel really includes marketing and what includes sales. And in my own experience, both consulting with companies and my experience at Dwala, I don't think you can underestimate what you consider marketing and trying to get your name out there. The more that an investor has heard of your name before, has maybe seen you pitch, has met you at a conference, has read about you in a publication, has maybe seen what you talk about and post on social media, etc., that's them starting to get to know you. Them learning your name and your company the first time is not really where you want to start the sales process with anyone. So the more awareness you can build early on will help the overall process. And of course, who doesn't love inbound leads, right? So instead of you cold calling, if you think about it as a sales process of having to cold call and reach out to every investor, sometimes the best fit are those that come to you. They hear about you, they reach out to you, and they want to learn more. That's the ideal that you're trying to get to. And I think it really does happen. I've seen inbound investors really come through involvement in accelerators, involvement in pitch competitions, speaking at conferences, where you never know who's in the audience and says, I'm interested in that, let's talk more. They've already showed that they care about what you're interested in. So starting with filling the process, just like sales, it's like there's different investor strategies. Who's your ideal customer? Who's your ideal investor? And thinking through that, there's a lot of different ways to raise funds. Early on, you might start with this friends and family round. And in a friends and family round, the company will normally set the terms. You'll say, hey, I'm raising 400,000. It's either debt or equity. We're looking to close by this date. There likely won't be a board seat at this point. And multiple friends and family will come in to invest. Anywhere between 5 and 20 individual investors could come into this round. It's sometimes hard to jump over the friends and family round. So if you are, in that pre-seed and you want to go right to angels, you might get a little pushback that you haven't been validated by people that know you, the friends and family. I've heard, some angels won't invest unless they know that you have friends and family that have already, validated your character, validated that your good idea, hard work ethic, know you personally and have put money in. So another strategy is that angel seed round. And we're going to talk about if it's led by the company or if it's led by the investor. So if you go the route of leading it by the company, this would be where, again, as a company, you would set the terms. There would be multiple angels coming in to invest. And again, they likely won't take a board seat because there won't be one majority kind of entity. It'll be multiple entities that are coming in to the company. And when it comes to setting the terms, this is something that we see is like a very commonplace, especially in the Midwest, where you're setting your own term. And part of it is, like, I call it, you're kind of herding cats. You're herding a bunch of people that show interest. And so not one of them is going to step up and say, these are the terms I'm getting you. So that's why as a company, it's important to say these are the terms by which we're looking to raise money. A strategy that we see more likely a little bit further, maybe that maybe you've already did a friends and family, maybe done a pre-seed, is now getting to that seed investor where the seed or angel investor will lead. This is like more likely when you're going after an investor who might write a check for 200 to 600,000 or 700,000 themselves. So they've positioned themselves as the lead investor in your round. In this case, the lead investor will set the terms. Again, typically they'll want to invest 20 to 25% of the total round. At this type of investor, they have experience and knowledge that is relevant to your company. Some of the pre-seed and the company-led angel rounds, you might just frankly be looking for smart people that have money. They're going to add value, but they might not have specific relevant experience. But if you're going after an investor who's like, I'm going to lead it, typically they have a lot of startup experience and they have experience relevant to what you're doing. At this point, they might require a board seat. They're taking a bigger chunk, and so it's normal that they'd want to have more insight into the company. And hopefully they're more hands-on in the next round, helping you raise the next round. Now moving on.
If I can add there, I think that one of the things that's changed a lot in the Midwest in the last 3 years is the number of seed funds. So, and they're run like venture capital funds. So they're early stage funds that invest average checks of 250 to 350K. They're willing to be a lead. And one of the hardest things you're going to run into is finding your lead investor, finding the one that will lead and set the terms and do all the due diligence. As an angel, I don't feel comfortable leading rounds. I just don't. And a lot of angel groups aren't equipped to do the diligence to lead a round. So you can spend a lot of time with angel groups and find out that they're all really interested in your deal, but none of them want to talk to you until you have a lead about how much they want to put in or whatever, because they're looking for some validation and they're looking for expertise in doing the due diligence. So Teresa's going to come to some slides in a little bit about some different investors out there, but just Chicago alone has many, many, many seed funds. So does Minneapolis. Kansas City has more seed funds. St. Louis has more seed funds. So I would just tell you to think about how you're going to find that lead investor to help you round up those angels, and that these seed funds are a good place to start.
Mm-hmm. One place that I'm seeing people struggle a lot recently is between, are they number 2 or number 3? And they might go out thinking they're trying to get a number 3, right? And they get a lot of individual investors interested, and none of them are willing to lead. And at that point, you have to decide, are you going to continue down the path of really searching for that lead? Or are you going to say, you know what, we're going to lead the terms and bring you all together? Frankly, I've seen people waste too much time trying to find a lead. And then they come back and just set the terms like 3-4 months later. And probably had they just led with, I'm going to set my own terms, they could have expedited the round. So just being aware of that going in, I think, is a helpful point and a helpful data point in your strategy. Strategic investors. Strategic investors, really there's trade-off in strategic investors. And so this is, they might help by potentially being a customer or opening the doors to some commercial deals. Having a brand, like a strategic name, might legitimize your company. They might be able to provide a ton of industry experience. So in that sense, they can be really beneficial. On the downside, they can potentially really hurt your company long-term by doing what's in their self-interest. I've seen where some strategic investors start to treat your company as their outsourced IT of, hey, what if we did this? What if we did this? What if we did this? And all of it matches back to their initiatives, but maybe not the best strategy for your company long-term. They might have too much influence on the direction of the company based on their own lens versus the entire ecosystem's lens. So you could go down a path that might seem like it's a great market opportunity within their worldview, but maybe it's a smaller market opportunity in the whole grand scheme of things. Some strategics might actually cause competitors to not want to do business from you, so they could block potential customers. And they might, if they're not a great strategic partner, they might block future rounds. So be aware of that. I think there's ways to get around it, even in the way that you get to know them. Look at what other types of deals they've done in the past, and try to understand, kind of what's their culture and what kind of investor are they, to try to flush out some of these.
Therese, there's a question here from Steve. What if you skip friends and family by investing your own money? How do you think this is viewed by investors? I'll throw in my 2 cents. If you're putting your own money in your own deal, I'm really impressed.
I would absolutely, I would absolutely agree. I think it's back to some investors won't invest without friends and family, and I would say others won't invest unless you've personally put anything in. They want to know that this is more than kind of a project where, oh, I'll take your money and if I lose it, big deal, right? Like they want to know that you have a lot of skin in the game beyond just your time. Depending also what life stage you're at, I think investors are also, I'm going to say, sympathetic to, not everyone has just like large pools of money laying around. And so you do get credit also for kind of the sweat equity. How long have you been working on this and creating value? All right, building an investor funnel. When you start to think about who would be your ideal investor, really thinking about what kind of stage that they like to invest in. Again, you might have someone where who's done lots of deals, but they might have a requirement that they don't invest unless you already have $1 million in revenue. Well, you can continue to get to know them, but you wouldn't want to spend too much time on that kind of investor if you're doing an early stage deal. Do they have a sector? Do they like to invest in ag? Do they like to invest in insurance? Do they like to invest in SaaS companies? What kind of deals do they typically invest in? Do they have a preference on customer type? Do they like enterprise deals? Do they not like enterprise deals? You'll start to find different kind of methodologies and preferences that they have depending on what type of companies they typically invest in. Do they have minimum revenue targets? And you can find out a lot of this not only on their, so like the professional VCs and angels will have a lot of information online where you can start to learn about them. Crunchbase has a lot of information. Also just looking at kind of what kind of deals have they had, interviewing them. When I had, used to do investor calls, I would like to spend as much time asking them questions as them asking me questions. So I would keep a detailed spreadsheet. What are they saying about, revenue targets? What are they saying about what kind of, companies that they invest in? Do they like SaaS? Do they like products? Do they like physical products? You can get a lot of information from them. Have they invested in your competitors? Often you would not want an investor to come into your deal who has invested in a competitor. And most of the time they'll recuse themselves if they think that there's a conflict of interest. They'll say, hey, we're going to pass on this because we've invested in a competitive company. So building out kind of who's that ideal investor is an important part at the beginning, just so you're not wasting time. Again, this is about coming up with a really clear strategy so that you're not wasting time with people that are just likely not a good fit for you.
And I'll add to that a little bit. If you'll get some that start asking a lot of questions early on, but it's like the associates asking you a ton of questions, but you're not getting past the questions and moving forward. And you got to be a little careful there, because sometimes they're working on a deal, and this isn't the right thing. It's not good that they do this, but they're working on a deal that is with someone that's similar to you, and they're trying to pick your brain to learn as much as they can about you in prepping to do the deal with a company that's a lot like you. So you really want to be careful when somebody starts digging and asking a lot of questions. It's like Sheree said earlier, time out, where are we at? What are you looking for? What's the next step? Make sure that you're getting something back in the sense of they're really interested in investing.
Mike, should we pause here? I was just looking at chat. I think there's a couple questions in the chat.
Sure.
So there was a question about strategic investments. Are strategic investments in startups by larger corporations prevalent in Iowa? We are seeing it, I would say, in the ag space, also in the insurance space. And I think that some of that has to do with the accelerators and probably connecting those two groups of folks. And in terms of self-funding, is there an impressive amount? I'm not sure I have a opinion of like what's big enough. I think, anything over several $1,000s is looking that you've put some of your own funding in. Obviously, the larger amount, the better. But again, you're also putting a lot of your own sweat equity in. And then our strategic investments in startups by larger. I think that was the same question. Yeah. So we are seeing strategics. Actually, on the call, Jason, during his time at EMC, they made some pretty significant investment in a manufacturing / insurtech company. Jason, do you want to share any other perspective, what you're seeing?
I would say that more and more companies, not just in Des Moines, but across the country, especially in certain sectors like insurance, are starting to get more savvy in doing direct deals. Our gateway drug is often the accelerators. So for EMC and many others, it's getting our feet wet in the global insurance accelerator for us. But over the last 3 years, EMC invested in roughly 10 companies, but that was probably close to 20 deals when you include some follow-on rounds and even maturing to the point of leading. So the landscape has changed, in other words, over the last 3 to 5 years, when more and more companies are starting to take those direct investments. But here again, to your point earlier, I will also add, those are typically strategic investors. And there are pros and cons of having those types of strategic investors, in the mix.
Yeah, like Dwala, if we think back, 8-9 years ago, I'm trying to think where it is in the timeline, Viridian and the members group were a strategic investor. That was really the first big money into that company. And that was definitely strategic in nature. So it's been around, I know, in the Midwest for quite some time. All right, so how do you start to manage all the dialogues? here is a spreadsheet essentially of giving you an example of managing your investor lead list, and some things to think about of what's the firm name, what's the fund size. When you're doing research on investors, knowing their fund size is really important. And that gives you a clue into what kind of, how much runway do they have to make investments? How much of their fund have they already invested? One thing, not to go down a rabbit hole, but sometimes you get investors that are really interested in talking to you, but they don't actually have the money to fund you. They're fundraising their own fund. I've seen some entrepreneurs get kind of stuck in that loop where they have someone ready to fund them, but the fund is actually trying to close like their second fund and doesn't actually have the money to fund them. So just be aware, like it's not necessarily where, as an entrepreneur, you want to be kind of investing all your time. If they have a super large fund, I think it might be an indicator, unless they say that they do really, seed deals or angel investing, that you're probably too early. Again, so you don't want to spend too much time with someone that has a huge fund, because they're probably just not going to invest at your stage. Are you able to see or ask them what their average check size is? Again, this gives you indication of, if you say you're raising 500K, would they normally write 500K, or are they looking for the $1 million+ deal? Or maybe they only write 100K at their really early stage, and you would have to put multiples of them together to get your deal done. Do they lead? Do they not lead? That's a really important part in deciding kind of your strategy. Who's your contact? I mean, this is simple stuff: contact, email, and then have they invested in any companies like them, like you, trying to figure out kind of what industries they like, what types of companies they like. Word on the street. If you're going to take investment from someone, I would suggest you talk to other companies they've invested in. What are they like as an investor? What value do they bring? Do they have a good reputation? I think it's important to do your diligence as well. If I was to expand this spreadsheet, I would also have kind of notes of like, when did I last contact them? What did we talk about? Again, it's easy when you're managing 4 or 5 conversations via email, but when those conversations expand and over time you're managing lots of different relationships, keeping track of when you last contacted them. Sometimes they're waiting for something for you. They say, hey, when you hit this major milestone, you say you're trying to close X deal. When you close that, let's have a follow-up conversation. Well, notating that and being ready to come back to them when you hit those milestones are helpful things to track. There's a lot of different tools that you can utilize to research investors. And when I talk about researching investors, this really isn't that like friends and family angel round. This is more people that are that micro VC and onward type of profile. You can utilize tools such as Crunchbase, PitchBook. You can also find some public lists. So these are just some examples that I put in here a while ago of like, you're trying to find investors in your segment. So you can research, type into Google, VC funds below 200 million, for example, and that will give you, a big list. If you're in Europe, investors by Europe, Midwest tech investors. There's so much information online these days, so much even more than 10 years ago. So
if I can
sales. Yeah, go ahead, Mike.
Sorry to jump in there. So
No.
I just realized the link for Midwest Tech Investors is broken. So I put the right link into the chat. I wanted to stop, and I don't even know Teresa, if you've had a chance to see this. There's a lady from M25 VC, and they're a seed fund. They're a big seed fund. They do a lot of seed investing. She has put an incredible amount of time in documenting all the investors in the Midwest that are doing this kind of work, especially these small funds. It is a gold mine. And I can tell you several people have gotten a lot of benefit out of it. So I need to fix the slide, but more importantly, grab that link. It's a Google Docs link, and check it out, because it's really worth a look. It's probably the best one I've seen.
That's great, Mike. I mean, we used to pay interns. I think, I know companies that are paying interns to put together some of this information. So that is a gold mine. to just have access and start to figure out, who might be a good fit. I'm going to go through these next slides pretty quick, but again, it's just trying to give you guys some information of who's out there regionally that's looking at deals, and how do you start to look at your pipeline. There's different regional angel syndicate groups, Oklahoma, Des Moines, Omaha, Minneapolis. One important thing to know is these syndicates have a history of sharing deal flow. So if, for example, Plains Angel does a deal, they'll reach out to their counterparts in these other angel funds and see if anyone wants in, which can be helpful. It gets you access to more capital. There's certainly, like we're seeing in Chicago, a lot more state angel groups. Again, I'm not going to go through all of these, but know that they're here and you have access to this. Different angel groups again. This is something, I don't know, Mike, in the last 5 years, we're seeing more of these micro VC funds. And they're primarily, their fund size is, usually less than 50 million. They invest somewhere between the 25K to 500K, which can be a helpful sweet spot. And a lot of them also lead, which can be helpful as you're looking, if your strategy is to find a lead versus setting your own terms.
The other benefit that they bring is a lot of them have established relationships with larger VC funds. So think of them as the feeder to a large VC fund, because let's say M25 makes an investment of 300,000 in your company. Well, the next round, their pro rata might be a $2 million investment. They can't do that per se. So what they do is they partner with larger VCs and share deal flow, and sometimes share pro rata. But what it allows you to do is build a bridge to the next round. So they have a lot of value.
The other thing that as I'm paging through these, VC funds, frankly, early on, one of the things that I'm seeing most companies be successful at is this raising from wealthy individuals. And I have to say that it takes a certain amount of hustle. Well, all raising capital takes a certain amount of hustle, but hustling a bunch of individuals can be really fruitful. There's several companies that have raised several $1 million in the Midwest from individual investors. And there's kind of an important strategy is finding, who are the influencers in those circles. Sometimes coming back to some of these angel groups will start to get you networked into these individuals. Another thing that I'm seeing is like people that have been successful in your industry. So if you have some ag tech piece of technology, finding, almost like retired or maybe a little wealthier individuals in those industries can help jumpstart your fundraising, and they're well networked. The company I'm thinking of, it was a ag tech startup. They were able to really connect with several key players that were past CEOs of very successful ag companies. And from there, get connected to 20, 30 individual investors. So thinking about that strategy as well, I think is a helpful one, and one worth planting the seed for, that you might not have any luck going down this VC route, but you might have a lot of luck getting interest from individuals who have the interest and sometimes can really provide great expertise to your company. The downside, I would say there's a downside of managing, 10, 20, 30 individuals on your cap table. You're going to have to be really proactive how you keep communication rolling, update your investors, etc. There's a little bit of overhead in that route, but I think there's also a lot of benefits.
We got some questions here, Charisse. Starting with Bernie, is there a larger list that isn't specific to tech investment? Honestly, angel investors are looking for a pretty significant return, and most non-tech based companies don't have that return. So the problem with the traditional business investment, it really is more of the banking and the private loan world It isn't venture capital. Diana Wright adds in, at ISU, we've seen an uptick in product-based businesses, consumer products. Any good leads on lists for non-tech? Okay, so, you know, tech versus non-tech, that's a really gray line these days. Consumer-based products, some are doing fantastically well by using tech, right? If you look at, you know, Amazon's consumer base, but they use tech to get to you. I know it's a big example, but we're seeing people that are building products and selling them and doing very well, but they're doing it because of their great social media marketing and other things. So I think there are some companies that will invest in consumer products or some investment groups, but they're very limited. And it's simply because of the cost of bringing a consumer product to market. And Diana, I know you're probably shaking your head up and down on this one, but it's the whole idea of how much inventory it takes and filling the channel. And I have a client that has a lot of business with Walmart, and just the amount of money it takes to fill the pipeline with product to 3,000 or 4,000 Walmart stores is crushing for some people. So I think that you just understand that those product-based companies may not be able to be financed in the way the venture world works.
And I even
Shreese, the next one, why don't you take?
For anyone who watched Shark Tank, right? You're seeing very different percentage ownerships than what we're talking about. And often when I've noticed like some tech SaaS companies go on Shark Tank, those usually aren't good investors for them. Because the Shark Tank investors are always like saying, we want 30, 40, 50% of your company. Because it's a different profile most of the time. I don't know if you've noticed this, Mike. I don't watch Shark Tank a ton, but when you see like a tech company that's true tech and saying, hey, I only want you to take 10, 15% of my company, they usually get quite a bit of pushback. And that's, again, it's kind of like investor profile, what they're used to. So there's certainly investors out there. It's when Mike and I have kind of built this program, just know that the lens is mostly through tech. This is like based on fundraising for tech companies.
Yeah. There's a question here from Mahesh. For micro VCs, should we follow the same advice rubric as for large VCs? Generally, yes. I'm not sure if you want to add anything to that, but it's the same process.
Yeah, it's the same process. Micro VCs might not dig in quite as much as the large VCs when you're further along. Be prepared for, you know, different diligence at different periods of your company life cycle. But I would say it's the basically the same process. Okay, so we've talked about, you know, filling the top of the funnel, starting to build your inbound strategies. Again, not only you reaching out to investors, but how do you have investors reaching back out to you? You know, some of the methods that work: PR, pitch competitions, conferences, networking, CEOs, getting other introductions from CEOs, other introductions from other startup founders, building that personal network, accelerators, and building relationships. And I'm not saying you should do all of these. Pitch conferences and conferences for some people might be absolutely not something they want to spend time on. I totally get that. You might have a large network of personal relationships, and that puts you in a position to maybe not have to do those. For others that, you know, you might not have a big Rolodex today, seeing how you get yourself in front of people and start to build relationships might be one of the strategies that you take. So it's examining, you know, who are you, what's your network look like, and how can you start to build awareness around your company to fill that top of funnel. Again, I can't emphasize enough throughout the sales funnel, how you continue to demonstrate momentum is so important. Where are you with your product and tech? Are you making progress? How are you doing on early users? Do you have any sales traction? Are you getting any news, any traction in the industry? What kind of partnerships do you have? So all things that throughout the process to keep in mind of continuing to build that momentum. And, you know, as you build momentum in these areas, they start to influence the awareness that you're able to gather. As you work through kind of the narrowing of your funnel, we talked about this in starting to build the investor tracker sheet, but trying to qualify the investors. Who would be a a good investor for you? What size of fund do they have? What type of check size do they write? Do they lead? Do they not lead? Are you talking to the right person? Are you talking to decision maker? What's their kind of, what are they known for? What are other people saying about them? And as much as you're qualifying them, you know, they're also qualifying you. These are kind of dual processes. An evaluation, not only as they evaluate you, you also want to evaluate them. Things that they're evaluating you on. What is your team like? Do you have a good team? Do you have expertise in what you're doing? Is there big enough market opportunity? Do they believe in your business model? What are you doing to create a competitive moat? And are there any red flags? Sometimes, some of the things, I think I'm just going to give a little example here. Raising money can be tricky because you're trying to figure out your strategy as you're talking to people. I realize as startups that you're often trying to solve multiple problems at one time. One thing to be aware of though is like you're being a little unknown of what your strategy is can cause red flags. It can also come across as maybe you're being dishonest. Are you holding something back? So be really mindful and truthful when you're talking to investors as far as where you're at, what you know, what you don't know. I've also seen people that are like, they're trying to sell this vision that's 10 years down the road. And it can be confusing. It can raise some red flags because what you're doing right now might look very different than that vision. So how you map kind of the future with the current as they're evaluating you can be really important, that it doesn't throw up red flags or trust issues. I think this was a great comment in the chat. Are team members talking over each other or even arguing during the pitch? That's a great point to raise up. You know, what are the team dynamics, especially over Zoom? If you're pitching over Zoom, what are the team dynamics? And have you figured out how you team and put a united front forward as the investors are getting to know you? Investors are smart, they're savvy, they pick up on those little things. All right. Any questions when it comes to, you know, really treating raising capital like a sales process? Any questions, comments from the group here? Clear as mud.
I will go back while we're waiting for questions. And, you know, Shreese mentioned I hear this, I'm not comfortable doing sales. I'm going to reiterate what Shreese said, get comfortable. And by the way, everybody sells. You sell every day, trying to convince your kid to eat, trying to negotiate where you're going out for dinner, trying to decide if your spouse or partner thinks it's okay if you can spend $100 on a tech toy. You're selling all the time. So those people say, I don't know how to sell. Yeah, you do. You just don't call it sales. So get comfortable.
Yeah, and hopefully as we, you know, talk this afternoon around the pitch and the way you tell your story, you can get clear on probably no one has as much passion for the startup as what you do. And having that come through in a very concise manner in your pitch is usually the most compelling part of the sales process.
It is.
I'm just reading a tip here from Diana. I've seen a number of entrepreneurs create monthly founder updates with a simple email to stay top of mind and nurture investor leads and strategic industry partners. Thanks for mentioning, Diana. That's an absolute kind of like top 5 strategies that we would suggest people do, you know, as you're building out the number of people that you're talking to, keeping the momentum and keeping your startup top of mind for them is really helpful.
And I think that to add to that is start that process really early as you're starting to introduce yourself to potential investors long before you're going to raise capital. You need to stay top of mind with them before you're raising capital. So I think it's a good idea to start your list of potential investors and just start sending out updates, you know, and the thing about, I'll add one other tip to that is make asks, right? We see this a lot and we push it in accelerators is, we had a company come into the Techstars Accelerator here in Des Moines. And one of the companies that I had a very brief meeting with put me on their list, and they sent out an ask, and it turned out they were looking to connect with certain kinds of people that were the potential customer. I was able to make 9 connections for them with 1 email. All right, and that was huge for them. And no, I'm not an investor yet, and I don't know that I ever would be, but that simple ask that went out to the people, first it tells me who they are. I get to know who they are. I get to know more about their company, but they actually got something out of it. So start that early and ask for help where you need it, very specific help.
Lynn, your chat, I'm going to call on you. Can you expand on this?
Hi there. Yeah, I just, I guess my point was just that this is all making sense, but, we're the startup that I'm affiliated with, we're like pre-seed. And so I think until you really jump in and have to start really seriously thinking about some of this stuff, that's where the rubber hits the road.
It's helpful context. Well, and I think what we've seen too is people have joined these classes several times because it's like sometimes it's the 101, right? I want to understand what I'm getting myself into before I get myself into it. And then you're in the middle of it and you're kind of like, I could use a refresher on some of this or hear it in a different way. So absolutely, this is meant to serve both audiences, those that are in the pre stage and you're trying to figure out what you're getting yourself into, and those that are actually going through it.
Yeah, and totally.
Yeah, some of it will seem like a foreign language until you're in it, and you might, hopefully you'll recall, oh, okay, that's what they were talking to, and maybe the context will make a little more sense in the future. But what we always try to aim for in these seminars is that you're not learning something for the first time by talking to an investor. You've kind of thought through it or heard about the concept prior to those conversations. So,
yep.
Okay, so moving on, we've talked about, really preparing for the investment. Due diligence. Due diligence is often a big part of the process. And when I say a big part of the process, it can be really time consuming is kind of more of what I mean. And also depending on who you're raising from. So if you're doing friends and family, I don't want to say no one's going to do any due diligence, but likely that level of investor knows you, knows someone that knows you, and they're not going to be diving through materials looking at this material. So just know, again, it's like, what stage are you at? When you get to the point of having a lead investor, that's really where this kind of formal due diligence process comes into play. Depending on who's leading, they all kind of have their own list of things they want to see, but we've tried to take those common lists that we see regularly and create a starting framework for you. So preparing for due diligence, make your bed, get prepared, have a depository, form your team. When we say form your team, oftentimes at this stage, if you have a lead investor, you're going to have an attorney on your team. Likely you're going to have an accounting team member who keeps, all your books up to date, taxes, everything. So know who's on your kind of team that's going to help go through diligence. Create a receptacle, put your stuff there, and update it. Please don't wait for someone to give you a diligence list to put the information together. From my own personal experience, you're going to have to pull like multiple all-nighters if you wait. But the first time I had really raised capital, no one had prepped me about, prepping for due diligence. Like, it just wasn't something that anyone had said, have this all prepared. And it took me like several days to pull it all together. Luckily we had kind of over the weekend. And so I didn't show my cards to the investors that we didn't have it prepped, but we were tracking down, even formation documents from a founder's basement. I like, don't let that happen to you. Do that ahead of time. The more organized you are, the better kind of first impression you'll have. If you can find advisors who have been through the process before, attorneys, accountants, they can help you anticipate what you're going to need. I guess my personal recommendation is like an online platform, Dropbox, Box, Google Drive, OneDrive, something that you can track who has access to it. add people to have access, take away access, etc. USB stick, I would not recommend. I don't know of anyone who even asked for this, but we kind of put it on there as like, this is a red flag. I would not recommend that you put any of your company information on a format that you can't, take it back. So due diligent organization, there ends up being a lot of information in your Dropbox or your diligence over time. So having a, well-organized structure can be helpful. I find that there's usually like 6 or so categories that most of the diligence falls under. So your corporate docs, who are your employees, metrics, financials, market, customers, products, partners, agreements, and PR, customer reviews. So if you set those up as your master format, then you can do subfolders for each. The further along you are as a company, the more information that's going to be here. Some examples of corporate documents. These are all your LLC or your, well, early on probably LLC, but then your corporate documents long-term, any IP, patent, technology information you have, stock grants, cap tables, options, etc. Getting down into, again, once you have more than, 4 employees, you'll get into what's the organization chart look like? Do you have employee agreements for everyone in place, or is it, you don't even have those in place? Who are your past employees? They want to understand kind of who might be some of the, is there risk with how many past employees you've had? What are the bios of the key people on your team? My monthly financials. Again, investors, once you get to a certain stage, are going to want to know that you have monthly financials and annual financial statements. For some companies, this might be very loose early on. Know that when you start to raise capital, having your financials done and buttoned up is really important. Your tax filings. Have you been filing your taxes? Do you have them? All important things that an investor starts to look at. Not to gloss over, market, products, customers. A lot of that information they will gather through, a pitch or conversation with you. Sometimes they might ask for kind of more in-depth information around those areas. But what I'm finding is normally the due diligence is usually around financials, team, in those kind of governing documents that they really want to see. Some best practices. I would suggest creating separate folders for each investor you share material with. I talked about this a little bit earlier, but if you're talking to a couple different groups, you might lose track of what's been sent, what do they have access. What starts out saying oh, let me just email that to you, you can easily kind of forget who has what. So, if you start to talk to 3-4 investors, I would suggest you create a Dropbox, put everything in there so you know what they have access to, and you can, pull back access when you're done. Don't share due diligence data until you're certain of a certain, serious interest. I've seen kind of a first-time rookie mistake where someone was so excited they had their Dropbox that every time they started talking to an investor, they said, oh, let me send you my data room. That's a little too eager and I think unnecessary. You don't want them to have that access until there's a real serious level of interest. And frankly, it doesn't do any good to start to share this information with people until they're serious, because they're going to start to ask questions. And you don't really want to be dialoguing with everyone at this level unless you know that they're very interested in putting money into your company. Also, it's okay if someone—
I can add one.
Yeah, go ahead, Mike.
Can I add something there? You can become overwhelmed by the number of people asking you questions. So it is a time management thing to make sure that you're qualifying these investors and making sure they're worth the time, because you want to know that it's leading someplace. I've seen people literally drowning in this process because they've got so many investors asking so many different questions, and you have to cull it down, pick the ones you're going to focus on and not spend the time on the other ones.
Mm-hmm. And I think this is also where it's okay to push back on investors. I've been through several deals where people are just asking for stuff that would take me days to go put together. And as an entrepreneur, I have to decide, is this really something that is worth me spending days on putting together? Do I push back and say, you know what, I don't have that. I'm happy to jump on a phone call and give you some, background on that, but I'm not going to go spend 2-3 days putting together something that you think is valuable to you. And as an entrepreneur, I might not necessarily find value for my business. So knowing that there's kind of some dance there, some VCs, I mean, they have whole teams that just get paid to like dive into this, and you need to protect your time as well. And as investors, they understand that. I mean, they should understand that they're not trying to create days and days and days of work for you, that you could be, working on your business and working on customers. I'm not going to go through this. We kind of already started to talk about what are some of the common things. I would say that there's things in here that you might not have yet, right? Depending on what stage you're in, it's okay to push back on some of these. I would say this is kind of like mid-stage that you would easily be able to check mark all of these. Some of them also don't think they have to be a separate document. So if it says kind of use of funds, demonstrating how your funds are going to be used, well, that would be in your pro forma, right? So you can just say reference my pro forma. It's in these 2 or 3 tabs. Sometimes under like a marketing or sales question, you could say reference my pitch deck. It's slides 7, 8, and 9, and that's kind of what I have. Like, you don't have to go create a separate in-depth sales and marketing plan in the early days of your company. So then starting to fill the receptacle, we've talked about this. We've talked about this. Again, depending on how long your raise is, update it before the raise, during the raise, and then most importantly, if you just get in the habit of continuing to update your Dropbox, even after the raise, every time you've, maybe you signed a major contract, added a new employee, if you get in the habit of updating these documents, it will make future fundraising much easier. All right. Mike, should we take a 5-minute break? We have until 11:30, and I feel like, this might be a good breaking point. Yep. So
yeah, let's take 5 minutes.
10:35. I mean, it's a little more than.
Yeah, 10:35. Sounds good.
10:35.
Well, what do you think, Sharice? Should we get going?
Sounds good.
By the way, you have 13 tabs open on your browser.
13 tabs. That's not very many, Mike, compared to what I sometimes have.
I'm just messing with you.
Maybe that's why I had to restart my computer, because Zoom was like, this is too much going on. Can you see all of them?
Not really, but I can count the X's. So yeah, I got it.
Well, all right, let's go talk about what you don't want to know, Mike, is sometimes I have like 3 or 4 different windows with like 10 each. A little preview into my life.
Whatever works for you, Sharice.
Those are the things I think on Zoom you start to pick up on. All sorts of insights into people. All right, we're going to move next into, as we think about the process of fundraising, managing the close. I understand for some of you that haven't been through this before, maybe 3-4 months away from this, it might seem really far out what we're talking about. But again, the goal really in talking about managing the close is starting to plant some seeds for you. So when you do get there, you're kind of like, oh yeah, I remember, I might want to think about that area. So when it comes to managing the close, as you're trying to run a process and trying to get this done, quickly, efficiently, so you can get back to work, setting expectations for what's the close date. Often there's going to be attorneys involved from both sides. So saying, hey, we're aiming for 30 days, it'd be this date, or like, are we all agreed that that's what we're aiming for? Setting expectations for who needs to sign what. I would say this has gotten easier in like the digital world, where most everyone can sign documents digitally. I did have an example where one of my major investors was in an area where he didn't have internet access for 4 days. Little, you know, I just hadn't thought about being very clear that we were going to need his signature. So thinking through those things, who do I need to sign? Are they going to be available? Are they in a position to sign? Just so you don't have anything being held up. Making sure everyone understands their roles and deadlines, and knowing that this part of the process is going to require time and organization as well, to keep it on track and ready to close. I've seen too many times where people just think like, okay, we have closing documents, I'm going to let all the attorneys handle it, and it's just all going to magically happen. Like anything, you have to manage those parties involved. One thing I would suggest is creating a closing checklist. You might be able to collaborate with your attorney. I know some attorneys will create these for you. Other times you might need to take a little more active role in creating the checklist, and making, you know, who's doing what are you doing, what are your attorneys doing, what do you need of your investor, you know, mapping out what those documents are, who needs to sign them, etc. Depending, this is where I would really, you know, rely upon my attorney. Normally I would set a meeting with my attorney and say, okay, can we just create a list of everything that you know of, what I know of, is going to be needed to close this deal, and get it all kind of down on paper. One other thing to know is, you know, the first time I closed a big deal, it felt this like big unknown. I'm like, how am I supposed to manage something? I have no idea what all goes into it. And that's where I think the collaboration piece comes into mind, where I met with my attorney. I'm like, what are you doing? What do you all need to get done? And in the larger round you do, there's a fair amount of like filings that need to be done in a certain specific amount of time. And just being clear what those are, can be helpful so that nothing is really missed. I can't also, normally we would have Joe Leo, who's an attorney in town, on these calls. I think he's going to be on one of the modules later in the weeks to come. But you get to a certain point, and I would say you need an attorney involved to do the closing properly, and so that you're not missing anything or doing anything that's against regulation. So as scrappy as we are as entrepreneurs, at some point it is beneficial to ask for that help and ask for the experts to be involved. Anything, Mike, to notate on your side as far as getting ready to close a deal?
Well, I think just being on top of it and looking like you're on top of it means a lot. I'll double down and reemphasize on getting your lawyer involved. You absolutely need a lawyer involved. If you don't do the filings right, and we find out on the next round that you didn't do the filings right, it can blow up the next round. So it's not just, oh, I screwed up the paperwork. It's, oh, I didn't do my documentation correct on my A round, and now my B round just died, because it's going to take 6 months to unwind the problem I created with the SEC. And SEC is a serious thing. It is criminal penalty time if you get it wrong.
Right. It's just not an area to penny pinch, really, because what it's going to cost to fix some things will far outweigh any of the savings. Not to say you should spend a ton of money on attorney with a close. I would say more of the documentation is really standard, and you can get, you know, kind of those standard documents. So I think closing costs, you'll even see VCs start to write like they think the closing costs should go down from what maybe we were seeing 5, 6, 7 years ago, because the documents are so kind of rinse and repeat. But you're paying for kind of it's almost like an insurance policy that it's being done correctly. At the end of the close, you know, it's easy to be like, oh, we're done. Yep, the lawyers have the documents. Take the time to grab those documents, put them in your Dropbox, so the next round you have them, and you're not, you know, spending time searching through your emails, finding, hey, where are all those closing documents? Also, you can rely on your attorney to have good documents, but also know, in another year or two, the attorney you work with might not be at that firm. And so is it going to be as easy as what you thought to track down those documents? Really own the documents yourself, and make sure that you're keeping everything organized. Also, we would suggest that your cap table be updated right after the close with everyone's share certificates. I'm a big proponent to having your attorney manage your cap table. Again, the amount of money you can potentially save, a couple $100, is probably not worth the headache that can be caused by not tracking everything accurately.
Absolutely.
After the raise, Mike, I'm going to turn this over to you for this section.
I'll just have you move, if you don't mind, just have you move the slides. So
Good.
Go ahead. All right. So for those of you, I think I mentioned it, but I am an angel investor. My wife and I are active angel investors. So I'm going to speak to you from the investor's point of view, because this is really important. I can't tell you how many deals I've gotten involved with where it's like the entrepreneur disappears. And that's really, really frustrating. So we do want to be part of the team. We're here to help. And we're sharing we're sharing the pain and the good. So let us be part of that. I personally think you need to do monthly updates. I have some to do quarterly updates, and that's fine. I prefer monthly. And I mentioned earlier the asks, and it's really important that we get that chance to help where we can. You can't imagine the Rolodex, if you will, the old school term Rolodex, or the contacts that a lot of investors have. They may know the most esoteric person in the world that does happen to understand, how optical physics works in relation to XYZ. So don't hesitate to ask even the craziest questions. You never know who you're going to run into. You need to do an annual in-person meeting. Now Zoom makes that a little bit interesting, but you can do it over Zoom as well. We are sharing, there's a handout in the next, don't go ahead and move forward yet, but just in your slides, there's a sample update form. And one of the things I'll tell you is keep the structure of your update the same for two reasons. One, it's comfortable for the investor. More importantly, it's easier for you. Don't keep adding new things over and over. Please don't send me a 15-page update every month. I've got one investor or an investment that I've got with a person that's absolutely in love with their marketing statistics. And I get literally 15 to 20 pages of marketing statistics. I mean, it's nice, but I'm not going to look at them as an investor. If there's a question about them, that's what I want. I want the question. So next slide. And these are turned sideways. We can just skip by this, but it's in there for you to look at. We used to print this as a book, so there it is. All right, so let's talk about some truths. We're all aware that when you're pitching, it's the best possible situation. This is the coolest tech. We've got 20 new clients coming in next week. Everything's great. We know better, okay? So the truth is bad things happen and things get slowed down. So stop pitching, tell us the real information, share real numbers, share them frequently. We know you're going to have bad days, weeks, months, and even years. We know that as investors. It's a known. Don't hide it. I think there's nothing worse than hiding bad information. So projections should be based on known pipelines, what you really know is going to happen, not what you're guessing. The team dynamics. This is another place where your investors can help you. If you've got a team member that's just not working out, you're going to have to replace him or her or they. You need to ask your investors, do you know somebody? Because sometimes they know someone that could be that add to your team that you weren't aware of. Yeah, fibs catch up and hurt future investment potentials. I don't know. I can't tell the stories, but I've got people I absolutely will never invest in their companies again. I just won't, because they lied to me. All right, and I have no trust in them, and that really is critical. Next slide.
Yeah, Mike, one thing I might add is about trust. Your ongoing relationships. Think about the activities that you do to build trust. And I think trust is given, but it's also earned. And if you think about that in two ways, a lot of these communications is about building trust and confidence with the people that have put in money, and so that they will help you along the way and hopefully put more money in you or connect you with people that will put more money in the future, as well as just generally help you. You know, once they're an investor, they're there to help you.
Right.
I would say, you know, there's a caution of like, how much information do you share and how much into the weeds do you bring your investors? And that's definitely a fine line and a dance. But you also don't want to be so hands off that, you know, they have no idea that there's problems going on in your company. You need to give them insight into the things that they could potentially help you with.
Yeah, I would agree with that. So ask for help. We talked about a lot of this, but leverage their network. I can't speak strongly enough about that. And investors, here's a point that I think is really important. Over and over, I've seen where a company gets an investment I have recently, the CFO didn't work out in that company. They caused some problems. One of the investors in the company was a former CFO. She was able to step in because she knew the company, she knew the high-low financials, she knew the players as an investor, and really saved them an incredible amount of pain and agony of having to rebuild everything. And she was able to help them hire the next person to come in. So sometimes they're actually the short-term employee. As investors, we're the short-term employee that can step in and help do some of the work to get you bridged to that next point. Next slide. Yeah, share bad news early. Don't wait. If you wait, you may run out of money. It may be too late for us to help you. But you know, there's lots of things that can indicate there's a challenge. And if us as investors, and Therese is an investor as well, if we have a chance to see those early, we can help you correct course and keep things from getting out of control. And I think, I know this sounds like a lot of repeating information, but keeping your investors in the loop, and Therese is right, you have to decide what level. You've got to let them know early on where they can help you, you know, in the areas they can help you in. So, next. All right.
Dun, 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 dun.
Yeah, here we are, coming to the end. All right. So final thoughts, you're going to receive a survey for this session and for the future sessions. We hope to see all you this afternoon for the pitch session. Stay in touch with us. I run Plains Angels with Tej Davan, and I work for the Greater Des Moines Partnership. I'm happy to talk with any of you. My job is to work with startups. So if you or someone you know is working through a lot of this stuff, you know, when you say, oh my gosh, I've been through the seminar now, I really don't know where to start, you know, reach out to me. My email's out on the website at the partnership. I'll also put it in the chat here before we leave. But don't hesitate to reach out with any questions and let us know in the survey, honestly, what we can do to make this better. Therese, any thoughts from you?
I might just open up if there's any last minute overall questions that maybe didn't fit in a specific part of the morning, but if you have any general questions, we have time. We'd be happy to take some questions. It's interesting, Zoom versus non-Zoom, the amount of dialogue, you never know what you're going to get. But, you know, don't feel like it's a dumb question. I feel some of you have been chatting me privately. Some of those private chats, I would think, you know, they also benefit the group as well. So if there's any questions, we'd be happy to take them.
I would point out one other thing, that PDF that we sent. I don't know if you noticed, but Therese is on like slide 60 something out of 135. There's a very large appendix. Yeah, that's exactly what it was. Appendix of information attached to that deck. And it's a whole series of what Therese and I and others have found across the entire spectrum of raising capital to be really, really great information. It's a bit intimidating that there's, you know, 80 some pages of it, but I got to tell you, there's some of the, it's some real choice work that has been done. And we referenced one of them earlier about the, you know, what makes a company investable. And the gal who wrote that is probably one of the smartest people I know. And she wrote a very simple 3-page post that's, to me, is still relevant several years later.
All right. Well, with that, I think we'll wrap it up. Maybe Mike and I'll stay on for a little bit. If there's anyone who, is intimidated by asking a group question, we'll stay on for a little bit if anyone has anything else that they want to talk about. Otherwise, thanks for your time. And again, we look forward to hopefully having you join some of the other sessions that we're doing throughout this afternoon and the coming weeks.